and operate on core values so that you know what you're getting. We talked about finding a deal in our previous video. I felt it very important that we move forward to what we do, which is really establishing a baseline, a step-by-step of funding a deal. So the biggest thing is, of course, finding a deal. Knowing what you have is key. VICAP lending, like so many other lenders, established just in the financial industry a baseline. And what we do is we fund up to 70% of a deal, mainly talking to fix and flip. We're going to really establish and dig in on a fix and flip product. We also do refinance and new construction as well. And also commercial purchases and also residential purchases for rental. Okay, so that's just a little bit of what we do. But I really want to add some value to really help you understand how we fund a deal. So the biggest thing with funding a deal is finding a deal, right? We've done that. So once you find a deal, you want to know that we fund up to 70% of the ARV. Now, ARV is simply an acronym for after repair value, okay? Now, that value can also be considered a comp or comparable, okay? So when we look at a purchase price plus rehab, that you're all in, you compare that to the comp or the after repair value. We will fund up to 70%. And we're going to go into an example later. But along with understanding your comp, the next thing you want to realize is what dictates how much money or skin in the game you have to come to the table with. I like to talk about that because skin in the game is important to a lender. And there's two ways they dictate the amount. It ranges anywhere from 10 to 30% of the purchase price, okay? And with fix and flips, it's generally between 10 and 20. And when you get into new construction, it becomes 30% and sometimes more. So we're going to use the example, but we want to make sure we establish how do we get from 10 to 20. And there's two factors we like to say is credit and your experience really break down your down payment and your interest rate, okay? So credit, and experience, all right, those equal down payment and interest rate, okay? Now, for someone who has, we go as low as 600 on a credit score. We can even go below 600, but that'll be another video. But if you're at that 650 rate, what that is, that's considered moderate to good credit, okay? With that type of rate, we can get you possibly 10% down, right? But honestly, 680 will get you in that ballpark of the 10% down. But another thing you're gonna need is that experience, right? So then what is experience, right? If you don't know what a HUD agreement is, that's what dictates experience. That means you have went to the closing table, and whether you're on the operating agreement or you're actually the owner of the company that is shown on the HUD agreement, you need at least 4 completed deals to get you to the point where you'll be at 10%. And that's in culmination with this credit score. Now, no, if you have a 600 and you have no experience, the difference is this is when you get at the 20% down, okay? That's where we'll go into the down payments. That's where you'll need 20% down of the purchase price and 100% of the rehab still, okay? The interest rates, they're gonna go as low as 6% all the way up to 12% and more, okay? So let's break down an example of how you can get funded. That's the big thing, right? So we'll use the example of a $300,000 house times 70% is going to equal $210,000, okay? That's your all-in cost, okay? Now, if the purchase price was $150,000, okay, and then the rehab is going to be $60,000, okay, what that's going to say is we'll use the example of 10%, just an easy round number for an experienced investor. And of course, you could just double this if you're just getting started. So on this particular deal, they're going to have $15,000 down. That is not an expense, that's an investment. You get that back on the sale. Just know we're going to really break it down so you can understand the difference between an expense and an investment. That's going to be an investment, okay? Now it's going to be 100% of the rehab. We know that, right? So then if we look at this, that means we've got $135,000, right? And then plus the $60,000, we're going to have $195,000 loan, okay? So we've got a $195,000 loan. Now we're going to see how much are we going to pay in interest, points, and that's going to know that those are going to be expenses, right? So let's look at the 195 times 10%. We're going to be looking at $19,500, right? $1,905,000 is what we're going to pay in interest divided by 12 months, okay? So 12 months divided by that, we're going to be looking at $1,600.25 a month, okay? Now the $60,000 rehab project, we'll say 3 months, okay? So if we looked at 3 months times 1625, we're going to be looking at $4,875, okay? That's going to be an expense. You're not going to get that back. That's how the lender gets paid. So we'll go up over here and we'll say on the 195 loan, okay, we've got $4,875 in interest-only payments, okay? That plus there's going to be points, and it's anywhere between 2 to 4 points. So we're going to use 4 points as an example. So we're going to be looking at $7,800, right, in points, okay? Now we're going to look at closing costs, right? Closing costs generally, you could guesstimate about $1,500. All right, then we also, another expense is going to be your appraisal, okay? So your appraisal generally between $350 to $600, we're going to say $500. So when we add that up, we want to say $14,675, okay? So we're looking at $14,675, all right? Now that's going to be your interest-only payments on 195, your points to close, your closing costs, and your appraisal. Now, let's just look at it from an investor standpoint, okay? You've got opportunity at this point to make $60,000, okay? Now, with that $60,000, $90,000, with that $90,000, you're going to take off some expenses, all right? So we take off the interest-only payment, the points, and the closing costs, and $500, we're talking about $14,675, which at the end of the day, minus 90 from the 90,000 is going to be a significant profit. But I want you to know that you have to understand the steps that it takes to get funded, which is credit, your experience, and your down payment. And I also want you to know that when you're looking at from an investor standpoint, is the lender getting paid too much? A lot of times, you know, we count other people's pocket, and if we look at $90,000 in profit, you know, minus $15,000, you know, it gives us, you know, $75,000 in income. Well, how much is the investor making? If you look at the 2,000 here, okay, this is what the investor's making, okay? So we're looking at $12,675, okay? Now, if we take that and divide in $195,000, the investor is actually just making 6.5% on this money. And when you look at it overall, I mean, that's a okay return for him, but it's a better deal for us because, you know, as an investor, I'm an investor as well. We don't have opportunity from traditional banks. So what VICAP Lending was so excited to be able to do is be able to offer this funding to our clients and then also be able to educate them. So if you have any questions, definitely hit like on the video if it added any value. And then you can reach us at www.vicapitallending.com. You can reach out to us and there's an email. You can send us email on any questions you have. Thanks a lot.